What is going on, investors? Hopefully guys are doing well out there. Time to keep earnings season moving right along as we take a look at AT&T, ticker symbol T. Now, there's going to be a couple of groups of people that are watching this video. Some of you might have gotten this one close to the 52-week range. You've never been an investor into AT&T. And look, you picked it up in the teens, and now we're at the $20 mark on AT&T. So you're feeling pretty good about life. Now, there's going to be probably a larger percentage of you that are in my boat. And I actually checked my E-Trade account, and I'm up here at right under $24. I think it was $23.80 was my average cost with AT&T. Now, that's a little deceptive because there's been a lot of dividend reinvestment over the years. And so my average cost of what I've actually had to put in principal-wise, I'd have to dig in there and actually see, but it's actually likely less than that. My guess is actually probably close to the $20 mark. So some of you are watching this and you bought into AT&T at a higher price, and you're wondering, well, is this company finally turning the corner? Is this like 5-year downtrend that this stock has been in? Is it finally going to be over and we're going to actually have a rally in capital appreciation over at AT&T? Those are good questions to ask, and we'll try to answer them on today's video. Now, over the last year, AT&T up 3.4% over the last 6 months. This thing's been in rally mode, up a whopping 8.2%. That is on the heels of those Q4 earnings, which came out before the bell. Revenue coming in at $31.3 billion. That was just up fractionally year over year by 0.7%. It did miss expectations there. The company also missed expectations for full year 2023 guidance when they gave an adjusted EPS range between $2.35 up to $2.45. Wall Street was expecting a number closer to $2.56. But what Wall Street, I think, is focusing on is across the board. The company is guiding to higher revenues for the full year of 2023 in the low single digits. And that's really what this company has kind of become. From a revenue perspective, you're looking at kind of a lower single digit revenue growth on this company. It's not going to fool anybody for a high flying tech stock with a large multiple. You're paying just 7 times forward earnings on this one. You got a 5.79% dividend yield, and you're pretty much buying this one, reinvesting those dividends. And if you get the bonus of the stock rallying over the last 52 weeks from about $15 per share up to $20, that is the icing on the cake. Let's get over to these Q4 earnings. Revenues coming in at $31.4 billion or $31.34 billion. Again, just fractionally higher than a year ago. When you look at this on a full year, you're down about 10% year over year. The company did a decent job controlling costs. On the equipment side, that was down 6%, but your revenues on the equipment side down 5.2%. So some of that is just kind of offsetting each other. They have these other cost of revenues as well. Those were down 3% year over year. Your big cost, your kind of employee cost, selling, general, administrative, that was up fractionally 2% year over year. But you see on the yearly basis, they actually did a nice job. That was actually down 2.4% year over year. Now, here's the big kicker with AT&T, and it's going to blow up these entire financials, at least on the operating statement side. When we get over to cash flows, it's going to give you a far better view into what's going on over at AT&T. In the most recent quarter, they had to take this massive asset impairment charge of over $26 billion. And so you add that to your operating expenses, it's going to obliterate your operating income for a quarter off of $31 billion worth of operating revenues. When you take an asset impairment charge of $26 billion, yeah, it's going to spin your operating incomes negative. And for the full year, it's going to make your operating income negative as well. But if you take this $26 billion and you add it to a negative 21, same thing for the full year. You take 27, add it to about $4.6 billion, you get a year over year and a quarter over quarter view of AT&T actually looks pretty darn good. And that's what investors are focusing on today as the stock is rallying up over 5%. We are recording this during the regular trade about 8:30 a.m. Pacific time. Now, the big thing that everybody looks at when it comes to AT&T is the long-term debt. You see, they've done a nice job as they divested away from DirecTV. They divested away from the Warner Media Group. We could go on and on. The fact that they wasted money buying those things, they've had to take massive asset impairment charges as well over the years. But look, we are where we are with AT&T, and it appears they're starting to turn the corner. Notice your interest expense year over year for AT&T down 4% on a quarterly basis, down 9% on a year over year basis off $120 billion worth of revenue. Just $6.1 billion is going to interest at AT&T. Things are looking pretty good from that perspective. It's not going to turn around overnight. It's not even going to turn around next year. But if they keep moving in this direction, well, I tell you what, the cash flows are going to continue to move higher at AT&T as long as they keep that revenue steady, and that's what the company is guiding for. When you come over here to the balance sheet, again, different company now than when they had DirecTV and when they had the Warner Brothers Media Group. Notice $119 billion of discontinuation assets peeled off the balance sheet. As you peeled that company off, you spun it off. Now what you're left with is an AT&T that's strictly a phone company and an internet company, and that's pretty much it. So they don't need a ton of cash, okay? The assets in this business lie in property, plant, and equipment to the tune of $127 billion. And then you have the licenses that you acquire from the United States government and really around the world in order to operate your business. Those are to the tune of $124 billion. Now, you can come up with the money. That's over $250 billion right there in just property, plant, and equipment and licenses. You can either try to come up that money yourself for cash, or what most companies do is they borrow it. And that's what AT&T has done over the decades. They have built up a mountain of debt. We're to the tune of $128 billion. It's so big that the CFO actually highlights it on their balance sheet. Usually it's one of these line items down here. He puts it in bold right here because he knows that you're going to come and look at it. And I tell you what, it's gotten a lot better year over year. Last year, you had $151 billion in debt as they divested out of that Warner Media Group. They took some of that cash that they got and they paid down their debt to the tune of $128. And we saw on the operating statement, the interest expense on that continues to get whittled down. Now, what I do see for the upcoming year, you have just $7.5 billion of debt maturing over the next year. Certainly seems like a number that AT&T will be able to handle and continue to whittle these things down. Now, here's where you're going to get a good view into AT&T for the full year, because we talked about how you had this asset impairment charge that was gigantic, $27.5 billion. It obliterated your net income. If you look at this company from an EPS standpoint, net income, operating income standpoint, it's just really going to look bad. Because considering last year, you made $23.8 billion worth of positive net income, and then it swung negative, again, all due to the fact you had to take this asset impairment charge. Well, on cash flows, we get to add that back in. The other thing that you get to add back in on AT&T is depreciation and amortization. As you invest in this property, plant, and equipment and these licenses, you have to capitalize that cost all up front, but then you get to amortize that and depreciate that over time. Now, on your operating income statements, you actually have to recognize this as a dollar for dollar cash charge, similar to how tech companies have to recognize stock-based compensation dollar for dollar, even though it's not actually a dollar coming out of the company's pocket and out of their earnings. You have to recognize depreciation and amortization as a dollar for dollar charge on a yearly and a quarterly basis. Well, on cash flows, very similar to stock-based compensation, we get to add that back in dollar for dollar, and I think you get a pretty good view of the net cash provided by your operating activities over at AT&T. Went from $37 billion last year to a shade under $36 billion this year. Would we like to see this going up? Would we like to see it going in the right direction? Certainly, but considering where AT&T has been in the past and the mistakes it's made, investing in DirecTV, investing in the Warner Brothers Media Group, well, these things are getting a lot better. And then when you factor in something we won't talk a lot about today, but the company is not wildly overvalued. I mean, you're looking at like 7 times forward earnings on this one. You're earning a dividend of 5.79% on this one. So you're not wildly overpaying for a stock like this. That's why kind of mediocre performance is rewarded by shareholders, considering it has gotten and has been a lot worse for AT&T in the past. Now, your investing activities cooled down a little bit. They still had quite a few capital expenditures to the tune of $19 billion. It was a little bit lower at about 15.5 last year. Acquisitions cooled down. Last year, you did $25 billion. This year, just $10 billion. Overall, you spent about $27 billion on investing activities. Again, this is off the basis of $35 billion worth of positive cash flow. Here's where it gets fun with AT&T when it comes to these financing activities. Here's where you'll find your dividends paid, $9.8 billion this year, less than it was last year because they had to restructure that dividend as they restructured the company. So you're paying less on a dollar amount there. Now, the company repaid a lot of long-term debt, $25 billion here, another $18.4 billion in short-term borrowings. They did borrow another $4 billion here and another $3 billion here. So the company is constantly going to be borrowing some money, paying some money off, going to be constantly doing that. Certainly if we see interest rates start to come down towards the back half of this year, especially if they happen, I'm not anticipating this, but if they happen to come down rather violently, a stock like this actually will probably perform relatively well. If you have interest rates start to tick down, well, the 5.8% dividend yield is going to look pretty good. Other investors will start to connect the dots that this company is going to be able to continue to refinance its debt lower its debt servicing costs, churn out more free cash flow, churn out more operating profits, potentially raise that dividend even faster and higher than maybe its potential at the current time. Now, the other thing that I look for when we look at this company, now that it's just a traditional kind of phone and internet company, is I look at churn. So the companies on their press release are going to tell you, hey, look, our postpaid is this, our prepaid, our reseller, our internet, all this stuff. Here's our growth rate across the board here. But you really need to factor in the people that cancel, the people that go from AT&T to another device or another services. And you see here, we actually saw this was negative almost across the board over at Verizon. At AT&T, the churn you'd actually expect decent for AT&T, also likely having a contributing factor in the stock heading higher. Now, the stock, I'm on a weekly view with AT&T. It has been in a 6-year downtrend on the shares. Rarely see this in the stock market. I mean, back in January and November of 2016, I mean, again, we're looking at 6-7 years ago. This thing was at $32 and it's just been almost a straight line down. It has occasionally over the years broken up above this trend line. Occasionally, those have always have been your time to sell. Well, folks, here we are. We have broken above trend over at AT&T. So normally I would be a little bit excited about this, but this has happened several times and it actually has triggered a selling opportunity. Anybody that bought this stock down at the 52-week lows in this green box that we've identified on a previous show in basically the teens on the stock, I wouldn't blame anyone for taking shorter term profits here. Now, the question is, if you're like me, I'm in for this stock. We'll change this green line to purple. I'm in this stock basically where this purple line is. Can we rally up to this purple line? Well, I think it's potentially possible. You're going to have some relatively heavy resistance right where the stock is. You notice this level at $20 was resistance back here. I mean, we're talking back in 2004. Some of you guys might have been investing in stocks at that time. Same here in 2011. It was support resistance all along kind of the 2018, 2019, 2020 area. The $20 level held, and then once it broke, boom, we bottomed out. Now, that means we're going to need to see AT&T push higher than 22. I really think you need to get up into, basically $22 per share, another 10% move on this one. That would turn 20 in from resistance into support, and that would likely support that these were the lows back here in October for AT&T stock, maybe several other sectors and other stocks as well. And the stock should over time work its way back up to that $23, $24 area. And if you want to peel off your shares at that time and get into something a little bit different, certainly wouldn't blame any investors. If you just want the dividend yield to continue to reinvest on this one, collect that income, certainly our older viewers, certainly looks like to me from the financials that we're getting over at AT&T, the cash flows, the guidance, the fact that the company has finally started to shed off some of their very, very poor investments that they made over the years. If they can just simply run the phone business and the internet business for the next several years, well, this stock is probably going to be a consistent but small winner over the years. So there's room for AT&T in certain types of portfolios. Hopefully you guys enjoyed today's video. We'll obviously be back again with more. Good luck with your investments.